U.S. stocks are seeing their worst start to the year since 1995. That's versus global markets.
It's not just that the U.S. is down slightly, it's that the rest of the world is up sharply.
For the rest of the world to continue to outperform the U.S., they're going to have some fundamental follow-through. And frankly, that's not what we're getting quite yet.
U.S. stocks are seeing their worst start to the year since 1995. That's versus global markets, and it's according to data from Goldman Sachs. We got the Goldman Sachs data, but we also have our own eyes. And we have seen, if you look at various indices around the world and the global performance, ex-US, it has been better.
It's not just that the US is down slightly, it's that the rest of the world is up sharply. Looking at since the beginning of the year, the US is flat to down a little bit while the rest of the world is up roughly 8%. Put that out over a year, the US is up 11%, the rest of the world is up roughly 30%. And this is on a few things. It's on valuation, it's on concentration, and it's on a little bit of geopolitics. Starting with the valuations, you saw a note out from Apollo's Torsten Slok a couple of days ago. US stocks are just getting more expensive. They're now trading at a price to earnings premium of roughly 40% over the rest of the world. Those stocks are just getting more expensive to hold while performance is lagging. The US is also, as you know, Julie, highly overweight in tech. Investors are looking for some diversification right now. The rest of the world's equities can offer that, where the US market is so heavily weighted toward these names that are going to be dependent on how the AI trade rolls out. Finally, we've just got this geopolitical risk premium on the US that kind of won't go away, whether that's Greenland, whether it's Venezuela, whether it's the Trump administration's tariff regime. All of these factors combined, you're now seeing one of the biggest performance gaps between the US and the rest of the world we've seen in a long time.
Of course, everything is relative. So in other words, you're coming off of strong performance for the U.S. pretty consistently,
exactly.
Right? Versus in some areas, not everywhere in the rest of the world, you have them not, coming from a lower point, right? Mm-hmm. So there is potentially more upside,
right,
at least according to investors, for maybe someplace like Europe, for example.
A bigger growth story there, as some of those stocks, some of those regions have lagged over the last few years. The U.S. has been ticking up. Now you see investors starting to look at the international case a little more closely. I've been talking with family offices, with hedge funds, with other big investors for the past few years. And even though there's no large-scale capital shift yet, it is something that's starting to be on the minds of those investors. And they're starting to say, should I be considering moving some of my asset allocation abroad?
There's one country that keeps coming up over and over again as a place that investors like. It is Japan. And there is just now an announcement between the US and Japan for Japan to begin investing in the U.S. $36 billion is the first tranche. It's in an area that you are very familiar with.
Yes, it is.
In the energy industry, which is interesting.
$36 billion, and that's out of a $550 billion trade agreement. As you point out, this first tranche is going toward oil and gas and toward critical minerals. The majority of that money is going toward a very large-scale natural gas plant in Ohio, roughly 9 gigawatts of energy projected, and that's as Ohio is becoming a data center hub. So you see the play there for AI. For Japan, this is also a bit of a realignment, moving capital into the US and de-risking off China, off some of its other strategic dependencies, getting in on the US critical mineral play that the Trump administration is talking up, getting in on the oil and gas play there. Japan imports the dominant share of its energy. And so those external agreements are really important. The US tariff regime on Japan is also playing a role here in getting this deal across the board. One of Japan's driving industries is the auto industry. Think Lexus, think Toyota, think Nissan, right? Part of the tariff regime that the US has agreed on into this deal is that the levies on automobiles will come down. That's going to be a crucial lever for the Japanese economy to pull. And again, they import so much energy, so these kind of agreements are going to be really important for them.
Here's the challenge. When you look at the performance in 2025, the vast majority of outperformance for non-US markets came from multiple expansion, came from valuations closing the gap with the US. The problem is the fundamentals for those markets don't match the US. You don't have the balance sheets, the cash flow, the earnings, the margins, and what we think is the growth opportunity that you get from both tech and communications, the largest market cap weights within the US market. So last year you had a bit of a catch up. And, for example, in Europe, in 2025, about 90% of the return could be explained by this multiple expansion instead of by earnings. We think at this point in the cycle, it's incredibly important that the returns are driven by earnings and not driven just by valuations. For the rest of the world to continue to outperform the US on a total return basis, they're going to have some fundamental follow through. And frankly, that's not what we're getting quite yet. So, we've just come this big chunk through fourth quarter earnings. We have a good sense of what's happening outside of the US as well, although we know that reporting bleeds out a little bit further. And it's really important to note that the US earnings growth is meaningfully outpacing everywhere else in the world. So while yes, the US looks like it's lagging, kind of flattish, the majority of the returns, once again, from outside of the US are coming from multiple expansion. And currency adjustment also played a role last year. We're going to be watching that very closely.
So we've already seen that rally. Are earnings going to back it up? I mean, but there must be some pockets of strength. Some of the same trends that are fueling what's going on here, right? Data center expansion, power. Europe certainly has some strong industrial companies that are servicing the power industry, for example.
Yeah.
So there's places.
Yeah.
You're saying just like it's not as broad as maybe the multiple expansion would indicate.
Even before this multiple expansion, when you quality adjusted US and European markets and also sector adjusted, you actually didn't get that massive valuation discount that is the narrative. Everyone says, oh, Europe is cheap to the US. Well, when you look at the companies in the semiconductor space, in the industrial space, things that we have significant secular growth, they were actually trading at multiples commensurate with their US peers. Right? It wasn't this massive discount. So high quality stuff was well owned, and lower quality things, particularly the banks, which have been the largest driver for Europe, were trading at a discount. And frankly, they should, because they don't have the same, kind of structural environment as the US. This is what I would also say. There are places where earnings growth has been phenomenal, say outside of Europe, that also have put up great numbers on a total return basis. And some of that is in emerging Asia. That's another place that we've had an overweight in our portfolios. Particularly looking at Korea and Taiwan, some of these numbers are, off the charts. It is a very single story, single narrative kind of driver to that performance. But we think it can continue, and we're continuing to hold that significant overweight in our equity portfolio.